In this Back to Basics accounting video, we will be taking a deeper look into one of the basic concepts of financial accounting. You will remember that I briefly listed the basic concepts in the accounting introduction video. If you're not sure what the basic concepts are, you will find them there. Check it out. The basic concept I'll discuss now is the 5 basic account types. And this is rather important because accounting and reporting standards require that businesses record their financial information in a standardized way. And this is basically where the 5 basic account types had their birth, so to speak. Here's a fun fact. Did you know that the origins of accounting can be traced back as far as 300 BC? It's true. Tokens and bookkeeping scripts dating back to around that time were discovered in Iran. Anyway, the 5 basic account types are asset accounts, which are items that bring value to the business. Liability accounts. These are amounts that the company owed to other stakeholders. Equity accounts, such as owner's equity and shareholders' equity. These accounts consist of funds invested into the business as well as profits and loss generated by the company. Then you get your income accounts. These accounts consist of income earned by the business, and then there's the expense accounts, showing the cost of running a business. The role of these account types is to define how the company's money is spent or received, and each of these can be further broken down into several categories and accounts. These accounts are related to each other, and the accounting equation shows this relationship between them. If you need further information on this, watch the video on accounting equation. The 5 basic account types are important because they appear and are presented on the face of the financial statements. Assets, liability, and equity accounts will appear on your balance sheet, known as the statement of financial position. And the income and expense accounts appear on the income statement or the statement of comprehensive income. If you are familiar with the basic accounting cycle, you will know that the financial statements are the last step or report in the cycle. Now let's look at examples of accounts categorized under these 5 basic account types. Starting with assets. We already know that asset accounts show items that have value and are owned by the business. Asset accounts are further divided into current asset accounts. These are assets the business expects to receive cash for within 1 year. And non-current assets. It is expected that the business will hold on to these assets for more than 1 year. Current assets will include accounts such as bank balances, your cash on hand, for instance, petty cash, inventory, accounts receivable, in other words, your debtor balances, prepayments, and many more. Non-current assets will include, for example, fixed assets, such as buildings, computer equipment, fixtures and fittings, all at cost value, and then accumulated depreciation accounts, which is a negative asset account, reducing the value of the asset over time, and also long-term financial assets. Moving on to liability accounts. As already established, liability accounts show amounts that the business owes and must pay. Liability accounts are also divided into current liabilities and non-current liabilities. And as with assets, current liabilities means the debt will be paid in less than 1 year, and non-current liabilities will take more than 1 year to be paid. The most common accounts used under current liabilities will be creditors control. This is basically your suppliers who supply goods to you on credit, and accruals. And an example of a long-term liability will be loan accounts, for example, a mortgage on a property. If we then consider common accounts under owner's equity, it will be capital, which is the amount contributed by the owner, and the other account would be drawings, which is the total amount of assets taken out of the business by the owner. Let us now consider the common income accounts. Here you will find accounts such as current income, which is the main income account for a service business. Sales, which is the main income account of a trading business for income earned from the sale of inventory. Rental income, which is income earned from rent. Discount received, where the business received discount from your supplier on the goods purchased. Interest income, which is interest earned other than interest on fixed deposits. And interest on fixed deposit account, which is, well, basically exactly what the name implies. Lastly, let's look at the common accounts under expenses. So by now you already know that expenses show the cost of running a business, and there can be many expense accounts, but I'm only going to list the most common ones here. Cost of sales, which is the cost of your inventory sold. Discount allowed, which is discount given to your debtors. Salaries and wages, well, because you have to pay your employees. Advertising, water and electricity, telephone costs, stationery, repairs and maintenance, insurance, and interest paid, to name just a few. Remember, all accounts have a debit and a credit side, and depending on what type of account it is, it will either increase or decrease the account. So if I can give you a word of advice, memorize the basic account types and memorize whether it is increased or decreased by a debit or a credit entry. Knowing this will ensure that you record financial transactions correctly in terms of the double entry system. Make sure to watch the video on the double entry system for a detailed explanation on the application. So there you have it, short and simple. Subscribe for more Back to Basic videos, and feel free to like and share these with anyone who might benefit from it. And if you have any questions or you would like to see a video on a specific topic not yet uploaded, just drop me a comment below. Also, if you would like printable clips of this video, where you can make your own notes or something like that, just ask. I don't mind sharing.